This segment discusses the accounting for stock dividends. In a stock dividend, a corporation distributes additional shares of its own stock to its stockholders without receiving payment in return. A corporation would issue a stock dividend to put more shares out there in the market, which reduces the trading price of stock, keeping the price of the stock affordable. It can also provide evidence to shareholders that management is confident the company is doing well. There are two types of dividends. There's a small stock and a large stock dividend. In a small stock dividend, the distribution of stock is less than or equal to 25% of the previously outstanding shares. In a small stock dividend, we capitalize or set aside retained earnings for the market value of the shares to be distributed. In a large stock dividend, the distribution will be greater than 25% of the previously outstanding shares. In a large stock dividend, we are required to capitalize retained earnings or set retained earnings aside for the minimum amount required by state law, which is usually the par or stated value of the shares, obviously varying by state. So looking at the issuance of a small stock dividend, here is the stockholders' equity section of ABC's balance sheet prior to the declaration of the small stock dividend. They have 100,000 shares of common stock at a $1 par value currently issued and outstanding. Total paid in capital at par of 100,000. Owners had paid an additional 8,000 over and above par when the stock was originally issued. Total paid in capital 108,000. Retained earnings to date 35,000. Total stockholders' equity 143,000. On December 31st, ABC declared a 2% stock dividend when the stock was selling for $10 per share. The stock will be distributed to stockholders on January 20th of 2020. Let's make the December 31st entry. This is considered a small stock dividend because less than 25% of the outstanding shares are being issued. A 2% stock dividend times the 100,000 shares, 2,000 shares are being distributed. The current market value is $10 per share. So the total current value of this stock dividend is $20,000. So that's the amount that is going to be taken out of retained earnings. We are capitalizing retained earnings and setting some of it aside. The amount that will be recorded into the stock account upon issuance is the par, which is the 2,000 shares at a $1 par, total par of 2,000. That will be put into a dividend distributable account. We do not put it into the common stock account until the stock is actually distributed. This common stock dividend distributable account is a temporary equity account. We will hold this amount in there until the stock is actually issued. Then it will be taken out of this account and recorded into the common stock account. The excess that will be paid in, the difference between what it's worth on the market and the par value, $18,000, will be put into the paid in capital in excess of par on common stock. If we were to look at the stockholders' equity section before the stock dividend and after the stock dividend. Before the stock dividend, of the $143,000 of total stockholders' equity, $108,000 was paid in capital, and the other $35,000 was retained earnings. After the stock dividend, total paid in capital is $128,000, retained earnings is $15,000. Overall, equity did not change. What happened was within equity, some of the accumulated profits or the retained earnings were distributed and are now a part of paid in capital. So stock dividends do not affect overall equity. They just affect the distribution of equity within. In a large stock dividend, We only need to capitalize retained earnings for the par value or stated value, depending on the state charter. So assuming that ABC Company's 50,000 shares of stock at a $1 par value on its balance sheet is before the stock dividend. On December 31st, ABC declared a 40% dividend, which exceeds 25%, making it a large stock dividend. The stock was selling for $8 per share. The state where this corporation is registered requires they be capitalized at the par value per share. So we are going to take the 50,000 shares outstanding times 40%. This dividend will be 20,000 shares of stock at a par value of $1. The amount that we take out of retained earnings, $20,000. Decrease retained earnings with the debit, and we will credit this temporary equity account common stock dividend distributable.